Okay, so today we're going to start with chapter 10, which is equity securities. Chapter 11 is derivatives, and chapter 12 is alternative investments. Okay, not particularly very hard sections, but we will go through it. So, starting off with features of equity securities. Okay, most equity securities have a life, which is basically just a maturity date. So it can either be for 1 month or 5 years or 10 years. So some have infinite lives, but some have maturity dates too. Okay, a par value is the face value or the future value of the security. So when the life ends, then you're going to either get something back. With equity securities on stock exchanges, they don't have a par value. In America, they set it at like 1 cent, so that if a company liquidates, they don't have to pay you out anything. But if you have something called preference shares, which we'll see a bit later, they tend to do have par values, but normal common equity doesn't have par values. Then voting rights. So usually the voting right is 1 share, 1 vote. Okay, and what they do is they collectively elect a group of people called a board of directors. And what they do is they monitor the company's business activities. So sometimes there's cumulative votes, which means if you hold 1 share, you get 10 votes kind of thing, but mostly it's 1 share equals 1 vote. Okay, then cash flow rights. Okay, so this is usually with dividends made by the company. If you remember from bonds last 2 weeks ago, um, bonds give you coupons, and they also give you dividends when it's equities. Okay, in the event the company is being liquidated, assets are distributed following a priority claim called seniority ranking. So if a company gets liquidated, first gets paid is all the debt holders. Okay. Once all the debt holders are paid, then your equity guys get paid. But you get different. So you also get your senior and then your subordinate, and then you just get your ordinary. Okay, so once all the debt people are paid off, then your senior guys will get paid out. Once all the senior guys have been paid out, your subordinate guys will get paid out. Once they've paid out, whatever's left over will go to your ordinary shareholders. Okay, then you get different types of equity securities. The most 2 common types are your common shares, which are just ordinary shares. Then you get preference shares. So what a preference share is they will get paid out before ordinary shareholders. They'll also get dividends before ordinary shareholders. So they're just like a more senior type of share that is available. Convertible bonds. Okay, these can be converted into shares of common stock. We're going to see it a little bit later, but what it is if a company issues a bond, you have the option to convert it to common stock if the share price is better than what the bond is offering. So that's what a convertible bond is. Then warrants, it's basically like an option, but it's an equity-like security that entitles the holder to buy a specified amount of common stock of the issuing company at a specified price per share. We're also going to go through that a little bit later. And then depository receipts is a security representing an interest in a foreign company that trades like a common share on a domestic stock exchange. So what that is it gives, say, South Africans the ability to buy, say, a Japanese stock. What happens is the bank will buy the shares and then issue them on the exchange, and we buy from the bank, so not from the Japanese company. But we also will look at that in a little bit. Okay, classes of common stock. Okay, common stock, also known as common shares, ordinary shares, or voting shares. So definitely just know the different types of names, because they might not say common stock, they might say ordinary shares. And they are the main type of equity security issued by companies. Okay, it represents an ownership interest in a company. It has an infinite life. So if you buy, say, Apple shares, they say infinite life, but if the company had to go out of business, it's like a, so you don't know. Then you get one class of shares. So everyone has one share, one vote. Everyone's on the same level. Then you get multiple classes of shares. So you get Class A shares, which are superior voting and or cash flow rights. And then you get Class B shares. Now, the reason a company would have Class A and Class B is if a owner of a company wants to maintain control. So he will be Class A, and then the company will issue Class B. So he has superior voting and cash flow rights. Do you get the difference? Cool. Okay, so like I mentioned just now, you get preferred stock. They are called preferred because owners of preferred stock will receive dividends before common shareholders and will have a higher claim on the company's assets if the company gets liquidated. So that's very important to know the difference. Okay, it is typically assigned with a par value that, along with a stated fixed dividend rate, defines the amount of annual dividends. So remember, so like I said, on the American Stock Exchange, just normally common shares have like a 1 cent par value. So it doesn't really, but preferred stock does. Then you get cumulative preferred stock, which requires the company to pay in full any missed dividends before paying dividends to common shareholders. So if the company misses 1 month's dividends, but the next month is a super good month, people with cumulative preferred stock will have to get that extra dividends that they missed, and then only will they pay out the common shareholders the next month. Common shareholders, if they miss the dividends, it's too bad. Some companies have more than a single issue of preferred stock. Each usually carries its own dividend. Okay, then you get convertible bonds. I just wrote a definition here for you. Okay, so a convertible bond is a bond issued by a firm that offers a bond holder, which is the investor, the right to convert the bond into a pre-specified number of common shares. Okay, another name for convertible bonds is a hybrid security, meaning that first you started out with debt. Okay, so you so let's say, like, I'll use the example Apple issued a bond. Okay, you took out the bond. Then when you think that the stock prices are rising sufficiently and going to increase, then you can have the option to convert your bond money into equity. Okay, but if you change it to equity, then you're not going to get your money from the bond anymore. You change it, everything goes through. So convertible bond, if the stock price does not rise sufficiently, you're not going to convert the bond, and you'll just hold it to maturity and get your 1 million bond back. If the stock prices rise sufficiently, you have the option to convert it into common shares at a conversion ratio. So if it goes to, say, $100, you took a 1 million rand bond out, then you can have 1,000 shares, but can either be less, more, depends on the bond indenture. Okay, because a conversion is a feature to the bond holder, a convertible bond typically offers the bond holder a lower fixed annual coupon rate. So remember, if it's a benefit to the bond holder, the bond issuer is going to pay you less each month, just as compensation for the option. All good? Okay, warrants. Okay, these are another type of equity options. Okay, it gives you the option to purchase a company's stock at a pre-specified price and date. So let me just write that quick. Okay, so warrants are also sometimes called employee stock options for if it's an employee compensation. Okay, that's to align the employees' goals with the shareholders. So employee stock options. And the other reason they would do it is to raise capital. basically it's you don't own the stock until that day, at that time, if you decide you want to buy it. So you don't give the company money, it's like a piece of paper, it's an option. If on that day you want to buy the stock, you can. Yeah. At a pre-specified date and price. Okay, then you get depository receipt. Okay. Let me just write. Okay, so basically what a depository receipt is it allows local people like South Africans to invest in companies abroad that we don't have access. So we can't, you can, but it's a lot of money and effort to buy a stock on, say, a Japanese stock exchange or the New York Stock Exchange. So what, say, a financial institution is just, say, Nedbank, this is not a real life example, it's just examples. They'll buy Apple shares. And what they do is they then put them on a listed exchange here, and people buy from Nedbank. They buy Apple shares from Nedbank. So technically, they're still owners of Apple shares, but indirectly through Nedbank. So when you're thinking, if they had to ask a trick question and they say, would someone holding a depository receipt have voting rights in a proxy voting thing? No, because they don't directly own the share. Nedbank will have the voting rights because they bought the shares. So that's just one way I thought maybe they could ask the question. So the people who buy through Nedbank don't have voting shares, but Nedbank will have voting shares. So the example they gave here, a Mexican bank buys shares of Sony in Tokyo. The Mexican bank issues the global depository receipt to investors against the Sony shares it holds in custody. And another important point is here, the global depository receipts are going to be in the local currency. So in this example, it would be in pesos. In the example I gave, it would be in rands. And it would be trade on the Mexican stock exchange here. In South Africa, it would trade on the JSE. Okay, if they want to know what the American depository receipts are called, it's called ADRs. So instead of global, it's American. So do you understand? Fine. Cool.
So if they want to say,
Okay, then cash flow and voting rights. So the type of security is common stock, rights to dividends if declared by the board of directors. So there's no legal obligation for the company to give you dividends each month. So if they have a bad month, they're just not going to declare dividends. Voting rights proportional to ownership. So remember I said like the one vote, one share, one vote. And liquidation, if the company goes bankrupt, they get last. Okay, then after that comes your preference shares or preference stock. The right to promise dividends if declared by the board of directors. Board does not have a legal obligation to declare. So if they are declaring, they have to declare to preference shareholders before common stock. Voting rights, none, and liquidation, middle priority. Then debt security, remember they get paid out first. So whenever the company has cash, what they're going to have to do is they have to pay off the debt first. So remember, it's always a legal contract. A bond is a legal agreement. Okay, voting rights, your debt holders are not going to have voting rights. And if the company gets liquidated, then they have first priority on the assets. Okay, how this can also be linked is remember that bonds are lowest risk, so your debt security. Okay, because it's a legal agreement. And if the company liquidates, they get paid out first. So low risk equals low return. Okay, we know that the preference stock is in the middle. So common stock will be the highest risk because if the company liquidates, they're not promised a return, they're not promised dividends. So it's high risk, therefore highest return. I did make a side note saying that when equity holders do see that a company is not doing well, they're not going to put cash into a company. They're not going to upgrade, kind of like Eskom. Like they're not going to get any return. So the equity holders are not going to put in money to make things look good if it's not ever going to happen. So what happens? The quality of the assets actually decrease, which still means that the debt securities can have a decrease in money that they're going to get back. So even though it's legal, once it's liquidated, it's done. So they're not necessarily going to get all of their money back, but they will get paid out first. Okay, then just a FYI picture, historical annual returns on equity and debt securities. So here are our debt securities, which are your Lehman Brothers that basically caused the global financial crisis, Barclays and Bank of America, Merrill Lynch, and then you have your equity up here. So remember that equity is higher risk than debt. So what do you expect to see? A higher return. And I don't know if you remember from quant, standard deviation is usually measure of risk. Okay, these are from developed countries over here, these top three. And the bottom three are developing or emerging. So they did offer lower return than debt, but it's only marginal. So your developed countries, your equity gets higher return because of the higher risk. Okay, then valuation approaches. So what is a stock? How do you actually get what a stock is worth? There's three approaches that we're going to go through. You get your discounted cash flow, which estimates the value of a security as the present value of all future cash flows that the investor expects to receive from the security. Okay, another word is this is called the intrinsic value. Okay, and when I write out the formula, it's going to be called V0. Okay, common shareholders expect to receive two types of cash flows from investing in equities. Number one is your dividends, and number two is the proceeds from selling the shares. So we're going to go through it a little bit just now, but the intrinsic value is equal to your dividend 1/1 plus the discount rate. And say there's only two, you're going to hold it only for 2 periods. You're going to say div 2 plus future value, which is the proceeds, and then you discount that back 2 periods. So what you're trying to do is you're trying to work out the present value of the future cash flows and see what it's worth today, what you predict it's going to be worth today, and what it's actually selling at. So you're going to see if it's under or overvalued. Then you get relative valuation approach. So this is the use of price multiples. So if a company doesn't give you dividends, can't use the discounted cash flow. So what you're going to do is you're going to look at ratios like your PE, and then you can work out your earnings per share, and then you can compare companies like that because you don't have dividends. And then the only problem with this is that, how do I say this? They think that companies that have similar risk return profiles should be selling at the same price, and obviously we know that that's not true. So this is just one little issue with relative valuations, is that they think companies with the same risk return should trade for the same prices. Then you also get asset-based valuation, which estimates the value of common equity by calculating the difference between companies' total assets and liabilities. Okay, major issues with this is reporting standards. Okay, how is the quality of their reporting? Assets on balance sheets are usually recorded at historical cost, but we know that if you bought a building, say 5 years ago, is going to probably be worth more today. Not always, but most of the time. So reporting and actual market values are not really in line with each other. And then assets that you can't actually value as well are your patents, your goodwill. So it's another thing to factor out. Discounted cash flows is probably the most accurate, but if you don't have dividends and you can't estimate cash flows, you're basically going to have to do the other two in great detail and care. Okay, then implicit assumptions are valuation approaches, so basically bad things. Okay, DCF relies solely on estimates of company's future cash flows and assumes the company will continue to operate forever. Okay, so those two are quite important. The relative valuation approach does not estimate future cash flows, but instead uses price multiples of other comparable publicly traded companies to arrive at an estimate of equity value. So if you're wanting to invest in a company that's not publicly traded, there's something called unlevering and relevering that you'll have to do, but you'll have to use a public company to base your evaluation on. Then asset-based evaluation assumes that the company will stop operating and essentially provide a liquidation value, assets minus liabilities. Okay, so this is what I was talking about, the discounted cash flow. I'm just going to explain it. Don't worry, you don't have to know how to calculate it. So the point of a discounted cash flow approach is to work out the value and compare it to what it is today to what you think it is going to be worth in 3 years' time. So how long do they hold it here? Okay, so dividend is 4 in 1 year, 420 in 2 years, 450 in 3 years. And in the third year, you're also going to sell it for $150. Okay, so what you're going to do to work out today, you're going to say, what is your first dividend going to be worth today? So what do? You discount it. So 4 Rand in 1 year is not going to be 4 Rand today. So you have to discount it. Then you're like, okay, 420 in year 2. How much is 420 worth today? Then these two you can just put together. So it can be 154.5 over 1.14 to the power of 3. What is that going to be worth today? Then what you do is you sum them up and it's 111.02. Then if what it's selling on in the stock exchange today is 105, would you buy or sell? No, if it's if it's selling on the market today at 105. So basically what they've done here is they've worked out if those are your cash flows and in year 3 you're going to sell it for 150, this is what you would be willing to pay today, but it's selling at 105. So obviously you would buy because it's undervalued. Yeah, so you think today it's worth 111 and it's actually selling at 105, score buy. If it's selling at say 115, then you're not going to buy. Then you think it's overvalued. So this is the reason why they do discounted cash flow approaches, is they compare what you think it's worth. So this is your formula, what you think it's worth today. Cool. Okay, company actions that affect equity outstanding, which just means that affects your shares outstanding. Okay, initial public offering is when a private company goes public for the first time, so they're selling shares for the first time. So first timers. Okay, seasoned or secondary equity offering is when a company issues a gain after an IPO, so it's after IPO. Okay, it's usually between 5 and 20% of what they actually have. Share repurchase or buybacks. Okay, it's basically buying shares back from the investors. Don't worry, I'm going to go through these slowly. So I'm just saying them now. Okay, stock splits and stock dividends. Okay, is when a company wants to change their share price, so what they do is they'll say, okay, from next month, 1 share is equal to 2 shares, but your value doesn't actually change, the monetary value. So if you're doubling the amount of shares outstanding, the price will have to halve. So it doesn't change how much your shares are worth. It's just changing the prices to either look more attractive. Exercise of warrants. We spoke about warrants earlier. It's where people can choose whether they want to exercise it or not. Acquisitions is when two companies join, so companies will issue shares if they need extra money to buy the company. And spin-offs are basically creating a new company from a subsidiary. We're going to go through that now. Okay, so your IPO. So it's when a private company goes public. So private going public. Okay, what are some advantages? It improves liquidity. Okay, obviously it's easier to sell any ownership in a public company. Easier to attract talent. Well, when more people know about your company, obviously you become more attractive. Raise visibility and awareness, and it's easier to raise capital, okay, because they can see your history. So for growth purposes, if the company is public, much easier to get money. Disadvantages: requires greater disclosure and transparency. We know from accounting that you have to be tip top, otherwise the SEC are going to come and find you. Increased regulatory requirements, and it is quite expensive to do an IPO. I think it's like 10% of whatever you raise goes to the underwriter. So it's quite a lot of money when you're dealing with big boys. Okay, seasoned or secondary offerings. Okay, this is just after an IPO if they want to sell additional shares to raise more capital. Okay, the selling of new shares by a publicly traded company after an IPO is called a secondary offering. The costs are lower than associated with the compared with an IPO, obviously because they're established. They don't need to do all of the first steps to get listed. They're already listed. And for an existing investor who does not want to buy additional shares in the seasoned equity offering, the increase in the shares outstanding dilutes the investor's ownership. So basically, if you were owning 5 out of 100, now they're issuing another 100, now you're only going to own 5 out of 200. Unless you wanted to double how much you owned in the offering. It doesn't dilute how much the shares are worth, just dilutes the ownership percentage. So basically what happens is, if you own 5 shares out of 100, okay, and they're $1 each, so it's $5, and what is 5? So that's 5%. Now they've issued another 200, so it's 5 out of 200, but they're still $1. So your value stays the same, but now you only own 2.5% of the company. So this stays the same. It's this that decreases. Does that make sense? Cool. Okay, share repurchases. Usually they do this to look more attractive. So it can either be done on the open market or in a formal offering. So it's where a company wants to buy back the shares that are either on the market, so like anything that's outstanding, or they go to shareholders and they say, listen, I will, it's worth $5 on the market, but I'll buy it back from you at $7. You can say yay or nay. So what happens when it's a share buyback? Basically the opposite of what we've just discussed. So say there are 100 shares outstanding on the market. They want to halve it, so 50. Okay, they only want 50 outstanding. Again, you own 5 out of 100, which equals 5%. But now, if they're halving it and you still owe 5, but you didn't want to give them back your shares, now you own 10%. Still worth the same, but the percentage ownership increases. Why a company does this is, remember the formula return on assets is net income over total assets. When shares outstanding decreases, your total assets decrease. What happens to your return on assets? Increases. Looks good. Earnings per share. Okay, so the company's earnings over all the shares outstanding. Shares outstanding are decreasing. What happens to your earnings per share? increases. So it just makes it look more attractive. They do this when they have excess cash and they can't reinvest the money into growth opportunities. Doesn't look good just to have cash on hand. So this is the kind of stuff they all play with. Okay, stock splits and stock dividends. Okay. Almost exactly what we've been saying from the start, except now. So what this example is if, say, a company's stock price is too high and now people investing are decreasing and decreasing and decreasing. What they do is they're going to do a stock split. So they have 24,000 shares before the split worth 75 euros each. Sum total is 1.8 million. Okay, what are they going to do? They're going to do a 1.5 split. So they want to decrease the price by 1.5. They want 50 euros per share each. So what do? They times that by the number of shares outstanding. You get to 36, and you can see that it doesn't change the value. Only the number of shares and the price changes. So they want to decrease the price of the shares to get more people investing. All they do is they increase the number of shares outstanding by a split. So someone who owned 1 over here will own 1.5 shares there. And they can do a reverse stock split as well. So if the price is too cheap and they want to make it look more attractive, they just do it the other way around. Basically just playing. Okay, then just some other actions that affect shares outstanding. Exercise of warrants. We discussed acquisitions is when a company issues shares just so that they can buy another company, so they need to raise capital quite quickly. And a spin-off is basically when a company splits in two, so it looks, if they have a subsidiary, it looks more attractive by itself than if it's with the parent company. And that's basically what a spin-off is. Equities done. Understand